Good afternoon, ladies and gentlemen, and thank you for that kind introduction, Jeff. I just wanted to start by saying the world, I think, is changing pretty rapidly, and I'm going to say some things this afternoon in my keynote that I think will have at least tangential relevance to what all of you do. But as Jeff has described, my expertise is in investment, and particularly with a bias towards what we call real assets. Legal & General Investment Management, that manages over $1 trillion of investments, is where I'm at. And as Jeff said, I'm responsible for real assets, actually now 20.5 billion. So given the number that Jeff gave, you'll sense that we're growing pretty quickly. And there is a reason for that, which I'll talk to you in a minute. For us, real assets is a combination of real estate and infrastructure. And as I make some comments, you'll see why and how I think those things are connected. Just to start, though, I wanted in here a little bit later than I had wanted to. And the reason was, as I left the office, one of the chief executives from one of the northern cities that will remain nameless phoned me on an urgent matter. And it's because that said chief executive wanted us to invest in their city in a major scheme and wanted to sort of nail me down about it, and I'll come on to that later on. But the opportunities that we see as private investors in real estate and infrastructure in the UK are very, very much increasing rather than decreasing. So if you think we've had a good run, I think there's a lot more to come, and I'll explain why. Particularly the thing I'm going to emphasise is the importance of the relationship now between the public sector, be it central or local government, and private capital, and that's changed in a very meaningful way. The comments I'm going to make broadly fall into three categories. I want to say some things about where we've been and where we've come from. I want to make a couple of comments about where we are now, and then I'll say something about where I think the future is. So really in three parts. So first of all, where I think we've come from. So my business is really about investing in the built environment, and I think I come from an industry that has been profoundly backwards in coming forwards. I think we've been herd-like in mentality. I think we've been slow to react to new trends. I think we've been stuck in the past in terms of the conflictual relationship between landlords and tenants. We've been unimaginative. The training in my industry has been poor. We've been unable to attract talent. There's been insufficient ambition and characterised at worst by arrogance. And so I'm looking backwards, a bit ashamed of the industry I've come from. But I do think there are signs things are changing. Jeff mentioned that I've been at Schroders and Deutsche Bank, and I think in the old days, real assets was very much seen in professional investment management businesses as being the poor cousin, probably populated by people of maybe high EQ, but certainly low IQ, and I can't particularly argue with that. But I do think things are changing, because I think the sector I'm now in is professionalising itself and has got some positive momentum and dynamics that are becoming more appealing as we go forward. So moving on to the present and why I think things have changed. Real assets are becoming more important. So think about this first of all from the perspective of an investor, and what do they really care about? What does an investor really care about? And by the way, I represent the investment capability both for internal capital at Legal & General, but also external capital. And around about 70% of the money that I'm responsible for managing is third-party capital. So I have to think about what do investors care about. The reason real assets is becoming more important in a world of de-risking and pension funds maturing and thinking about the flight path as pension funds mature is real assets should be about a yield level that is stable, that is certain, that is predictable. You can capture something called an illiquidity premium from real assets, so something that you can target as being a good thing rather than necessarily a negative attribute. There are inflation matching characteristics that matter more and more for long-term liability matching for assets. And we do know that there's an issue about access to real assets. You need specialism and you need expertise to do it, but if you can capture access, you can benefit from yield, stability, inflation matching and illiquidity premium. And really investors don't care what you call it, actually. The assets I'm responsible for is described, real estate debt, real estate equity, real estate infrastructure, real estate equity. Investors don't really care what it is, that it's property or infrastructure. What they care about is the investment style, the investment characteristics that what we do can generate. So real assets is actually in our business a deliberate attempt to relabel something which is not so much about the sharp end of what we do and much more about its attributes as an investment asset class. We renamed LNG to real assets in January 2015, so just over a year ago, and in the past year, AXA have done the same thing, TIA, CREF have done the same thing, BlackRock have done the same thing. So I think this is an industry trend about these tangible assets that produce a certain sort of investment style becoming both more popular to investors and also more coherent as a total asset class. Then if you look at the opportunities that are out there for investors, one of the problems has been the wall of capital that has been looking for this investment style. And at one level, happy days for the likes of Legal & General Investment Management Real Assets. We have more money chasing what we do than we can handle. The bad news is in terms of how can we find clever ways of finding investments to suit that and to meet that investor demand. And also, what about the extent to which you're going to see a pricing bubble? Because clearly there is a potential for a mismatch between supply and demand to create a bubble and create an adverse outcome in the end. Well, I think the answer to that is really born of why I think things are becoming more interesting. So the answer to how things will evolve from here and what we've seen in the last 2 or 3 years is the investment universe we operate in is expanding. And let me take a step to the side for a moment. The government that used to fund social infrastructure is indebted, and for those of you who don't look at the numbers, it's not becoming less indebted at the moment, it's becoming more indebted. Local government, to which devolution has been passed in a number of cases, is, if anything, more indebted than it has been in recent decades, in many cases severely so. So the public sector is going to be less of an important force for investing in social infrastructure than it was. And at the same time, you've had banks that are typically funded by short-term money realise, partly through regulation that's being imposed, realise that they're not actually long-term investors. They shouldn't really be holding long-term assets and real assets. So the banks, in aggregate, are moving away from this sector as well. So this is creating a once-in-a-generation opportunity for long-term capital to invest in what I would call real assets, including social infrastructure, hospitals, prisons, schools, residential and the like. And if you think about a cradle to grave as a human being going through society, you might have started, some of us may have started in a hospital, then we may have been in a school, then we may have been a student in some sort of student accommodation. We may then have rented a property before we could afford to get on the housing ladder. Then maybe you buy a house. Then maybe you end up in some sort of retirement living, retirement home, retirement village. And all of those particular moments in anyone's life are characterised by bricks and mortar, most of which used to be owned by the state. And going forward, our experience at L&G is that most of those assets can be owned by the private sector. We have done deals ourselves in residential, in hospitals, in schools in recent months, and I think that's a really big growth feature going forward from here. The other side of infrastructure, by the way, is what I'd call economic infrastructure, so transportational and energy. And again, look at transportational demand for investment. Things like High Speed 2, things like Crossrail 2, High Speed 3, transit systems in cities around the UK. Look at the amount of renewables that we need to invest in the UK, and again, it's not going to come from the public sector. The amount of renewables that are needed in the UK, I won't quantify it, you'll know. There is a massive undersupply currently of renewable energy sources. So great investment opportunities and more about the private sector. In general terms, I would say that there is, in some pockets of the market, a aggressive pricing that we've reached based on the fact that there's too much capital chasing too few assets. So our job is to make sure that there are more assets, that we can manufacture assets or invest in greenfield or green constructed, not mature assets, so we can be part of producing the solution for social infrastructure and for the energy, the clean energy going forward. But there are pockets where there's overpricing. London would be a very good example where you can see some relatively stretched pricing based on international capital flows. But what I'm hopeful of is that the magnitude of the investment universe we look at, through the things I've described, is expanding commensurate with the volume of demand that we're seeing from investors, such that there is more of a stabilised, sustainable pricing level. And the industry that I'm in, because of that, is undoubtedly expanding. There are more and more opportunities. Things that are particularly topical for us, some really new things that I will briefly allude to. First of all, build to rent, and some people call it private rental sector, but we call it build to rent. The opportunity to develop professionalised, purpose-built rental property in most UK cities is absolutely in the sweet spot of what we should be doing. The returns that we can deliver are appealing. It has not been done in any meaningful way in the UK in recent times, at least. It exists in many countries around the world, so that's an opportunity for us. And you mentioned, Jeff, the Michael Lyons Commission. One of the things you have to think about in the world of the housing supply crisis is how on earth can we build enough houses? Depending on what numbers you want to look at, we need about 250,000 houses per annum. We're currently building less than 140,000 per annum. So how can you make up the mismatch? One of the answers, and we've announced something about this recently, one of the answers is to produce in factories what we call modern methods of construction, what some of you might refer to as prefabricated, terrapins, that sort of thing. Has a bad name in the past because it's not been done well, but the technology exists today that it can be done to a very high standard. It exists in Japan, in Austria, in Scandinavia, and UK has just simply not addressed that opportunity yet. So that's another thing that we're pretty excited by in terms of opportunities for the future. I was going to steer clear of the referendum because I'm sure there will have been people alluding to that earlier on. I don't see it as being something that is really for businesses to have a view on particularly. It's obviously a democratic situation. We are already seeing, however, in the world of real assets, that where people can delay decisions, be it occupational or investment decisions are being delayed. So at the very least, we're expecting to see a pretty quiet world in terms of volumes between now and June the 23rd. But I'll leave that subject there. So in terms of what the future will hold, patient capital that can invest in real assets is going to be growing in importance, as I said, because of public indebtedness, because of bank retrenchment. Long-term money really should be invested in the built environment. It should consider itself to be the guardian of the built environment. And I think the extent to which there are opportunities to structure funds around that opportunity, in my mind, it's an untapped potential area of significant growth. For us, we are investing in a whole range of cities around the UK. As I said, London's got signs of pricing issues. The rest of the UK has got cities in it which have got untapped and latent potential, many of which represent a very interesting investment opportunity for us. And we announced 3 deals last year where we got involved in Cardiff, Manchester and Leeds to invest in a pretty meaningful way. But there are a range of other cities around the UK that will benefit from that sort of trend. And it will be all about partnership between the public and the private sector. And the devolution trend that we're seeing, which is very much in its infancy, I mean giving powers to the city in terms of taxation and expenditure, that is very much in its infancy, and that's going to be a force for more real assets activity than we have seen. So back to my urgent call, which prevented me from getting out of the office as quickly as I would have liked to have done from the CEO in the Northern City who wants us to invest. They've recognised that we're long-term investors. They want to package up effectively a co-ownership structure that can bring in third-party capital that could well turn into a fund, and that's just one of many deals we're looking at the moment, partly based on the political momentum behind the Midlands engine and the northern powerhouse cities. That's very much on the agenda with George Osborne, and there'll be more of that as we move forward. And if you think about where is the capital going to come from to invest in the built environment of the UK going forward, who will own the new high-speed 2 stations that will exist in many cities around the UK, yet to be built, yet ready to be planned. Who's going to own those? It's not going to be the public sector. Who's going to own Crossrail 2, which doesn't look like a racing certainty right now, but I would say is highly probable? Again, that's not going to be the public sector. It's going to be the private sector. So again, opportunities for private capital, opportunities for funds to be launched, opportunities for capital to coalesce together and make these things happen. So I'm pretty excited about the opportunities we see going forward. And what I would say I'm doing is I'm trying hard at L&G to be courageous with this, trying to defy the status quo and be part of the change that's taking place where capital rotates away from the public sector and away from banks investing and more towards long-term private capital. And my job above all else is to seize the opportunity, which, as I say, to my mind is once in a generation. That's all I had to say, so thank you.